Okay. You also get convertible bonds where instead of just redeeming your capital at the end, there exists the potential for the capital outstanding to convert to equity. So this typically happens if the company does well. So if the share price crosses a certain threshold, then the bond documents would stipulate that instead of the bondholder getting their capital back at maturity, at that point that the share price crosses a certain threshold, the equity outstanding, or the debt outstanding would automatically convert to equity. And this is a win-win because at that point in time, the company, their share price is run. So it means that by converting their debt into equity, they've done calculations beforehand. You have your conversion ratio, and they've done the maths beforehand, and they've said to themselves, okay, if my share price runs at 20%, then I'm willing to stomach this amount of dilution. So the mining company has already decided beforehand. It doesn't come as a surprise when the bond converts. They've already done the mathematics to say, okay, this is the amount of dilution, but they've run their numbers to say that cost of the dilution is something that I'm willing to stomach if my share price runs. So I'm happy. So I'm happy if it converts. Okay. Conversely, if you look at the bondholders, so we bought a debt instrument, the share price ran by 20%. I had, let's say, $100 debt outstanding. Now, my bond automatically converts into equity. Okay. It's not an inconvenience to me either, because instead of having $100 of debt outstanding, I now hold an equity instrument worth 120. So I'm happy. So when my convertible bond converts into equity, I can then take the money and run. And I've done better than I would otherwise have done. So I can just do a present value of all the coupons that I would otherwise have received. And still, the mathematics would still make sense to me as well because of that conversion ratio. Okay. So I'd get sufficient equity so that's such that both parties are happy when the bond converts at the end of the day. So it's a coupon plus the option to convert into the equity of the issuer or the client or the mining company. Typically, these coupons would be lower than the coupons for a standard corporate bond because you get an embedded option. Okay. Because your debt can convert to equity and you'd be winning when it does convert, it's an implied option there. So that implied option price reduces the amount of return that you need to get from the annual coupons until you're waiting for the thing to convert, if it ever does. Okay. So you're actually paying for the option plus the coupon, but the option is the key kicker that you like when you are an investor in convertible bonds. For that reason, you're willing to accept lower coupons because you're getting that option as well. If bondholders convert to equity, then the mining company doesn't have to worry about a bullet at the end. And again, forms the base long-term liquidity of a company's capital structure. And again, these are homogeneous and not easily customizable to the issuer.